Hello everyone, welcome to Fearfully Greedy. In today's episode, I will do a quick economical financial overview of the metallurgical coal mining sector. That's because I own stock in one company. I did this analysis before investing, but I updated it and I thought it would be cool to bring it to the channel. See how you can do some sector analysis. It doesn't take that much time to know who are the biggest players, if your company ranks high in quality, in output, if it's the cheapest of the sector, and so on. Sometimes you discover there's an even cheaper company or a much higher quality company that you might be more interested. So I think it's very good. I tried to grab some of the already done analysis of the sector, but I found quite a big paywall. So if you see here, there were some reviews going for 6,000 euros, some going for 12, some just short-term market research for 2,000. So I said, well, let's see what I can do on myself. Also, I don't like listening to any analyst. Honestly, I prefer to do my own thoughts and maybe grab some ideas from some people then forming my own opinion. So that's what I did. As I don't expect something too technical, more on economical and financial terms, but I think it would be very useful to understand the sector a bit more. First, a quick update on the channel's portfolio. As you can see, I added some more Shinoken and Warrior Met Coal. So you can see here, I doubled the position on Shinoken and I had some cash left. So I just put some on Warrior Met Coal, so just 13 shares, but it was falling a lot on price. I said, why not? Let's put it there to some use. And then here I did a transfer of 2,000. So this month I added 2,000 euros and that's what I bought, right? So far, not a lot of appreciation. I think the portfolio is looking pretty similar, but since I didn't do anything else, let's get into the topic of today's video, right? First, quick disclaimer, I own shares in Warrior Met Coal. It would be one of the analyzed companies, so take that into account, right? When you listen to the analysis. Also, please, before doing any investing, do your own research, consult a professional, and don't take this video as a buy and sell recommendation. It's just for entertainment and informational purpose. If you are interested in this and like my content, consider leaving a like and subscribing. Okay, so let's get straight into it. First off, I wanted to differentiate between metallurgical coal and thermal coal. I think thermal coal has not a super bad outlook, but I think in 20 years we will be consuming much less coal. There will be carbon taxes everywhere. They will have a higher consumption in more developing countries, but I don't think it's anything growing. And the other part, I think metallurgical coal, the coal used just for steel, we will be producing more steel in the future. I'm pretty certain in 20 years the total crude steel production will be higher than at the moment. It can be that some more environmentally friendly way of doing steel is there and growing, but I think blast furnace, the one that uses metallurgical coal, will still be a big part of it, and it will be a bigger part or a bigger amount than now. That's my outlook. I don't want this to be a macro 20 years into the future outlook, but just to differentiate, because you say coal miner and sometimes that gets a bad rap. Also, another clarification, there are two ways of making steel. One is with blast furnace, which is 72% at the moment, and then electric arc furnace is one that uses a bit less coal and also a bit more electrical power, right? And also you can put more like a scrap, like old steel that's it's obsolete at that point, then you can use it to produce new steel, right? Just a quick overview of the two methods. You can see here, this would be the electric arc furnace. You can add a lot of scrap this way. You also need some coal in this method, iron ore, but this would be the bigger method at the moment. And what I am trying to analyze is the miners of this coal here. So that's for today's video. Just to keep in mind, this will be a traditional route. You for 1 ton, so 1,000 kilograms, you use 780 kilograms of coal, of this coal I'm judging today. And then on the second route, you only use 150 for every 1,000 kilograms of crude steel. keep in mind to make the highest quality, less impurities steel, you can only do this method, although this is improving, right? And also you can even add more than this amount, but on average it would be these amounts of materials. So you can see that the electric arc furnace, if it grows a lot, we will need a bit less coal. But what I think is electric arc furnace will grow a lot, but also blast furnace will grow, right? So at least we will be at this point, right? So this would be the graph. So the electric furnace would be this orange, and then on blue, blast furnace. If you see, we could say that maybe here it was like maybe 20% of the total production, and at the moment it's 27%. So it has taken many years for electric arc furnace to be creeping up on the market cap of blast furnace, if you want to call it like that. And maybe it's accelerating in the last years, like a bit more regulation and so on. So maybe it will accelerate. But what I think is maybe this grows a lot, the orange, right? But I think the blue will stay here and maybe keep growing, like on a normal, or at least stay at where it is. If it stays where it is, that's good enough for coal mining. Then another thing that goes in line with these miners is that the production of met coal, which is metallurgical coal, the one from now on met coal, is the green one, right? If you see, the supply is not super big, right? It's not growing, it's not exponential, and there are many new projects coming in. So for now, as much as is produced is sold. Then if we have some scarcity, the price might rise, and that might make these mining operations a bit more lucrative. But for now, it's not something that is growing a lot, right? Also, these 4 previous slides, I took the material from World Steel Association, right? It's a great source, it's free, worldsteel.org, if I'm not mistaken. And for an association that puts free material, the quality is superb and very up to date. And if you like steel or you want to do some research, I would encourage you to check them out, right? Now, the 10 miners that I analyze would be these ones here. We have Australian miners, American, we have some in Poland. There are some others, but these would be the biggest players, right? Also the ones that you can invest in the public market, right? I was in talks with Warrior. I'm invested in Warrior, and I was trying to get more material for this video. And so eventually we got to this document here. They sent it to me, and it's from RBC Capital Markets, and it describes the cost to extract 1 ton of hard coking coal from the ground from the main operation, right? And it's very insightful. I think it's very good, but I don't like relying a lot on analysts if I can do it on my own. So I said, well, what if I could try to get the numbers myself, see if what they say is true, because sometimes in accounting, companies do funny business, right? So I'd say I like to do things my own. So what I did is, first I made a mental model for this kind of companies. I wanted to see what were the most important parts, right? Here I divided it in 4, and I thought the mining business as a water business. In a sense, it would be business that have a big water tank, then they have some pipe, they set up some glasses with water, and then they sell it for some price, right? So we have 4 parts. The first one would be the leaks. So this is from the water we get out, the water we lose on the way. So this would be cost in reality. Then the pipe size. So how big is the pipe would be the production or sales from that miner. So the bigger the pipe, if you have little leaks, is very good. If you have a big pipe but a lot of leaks, so your costs are so high, you won't get a lot of water out, really, right? So that's a bit the idea I wanted to infer. Then the water tank size, I put it in 3rd because I don't think it's the most important. Normally we would say, the bigger the tank, the most expensive the company should be, or the more value. But the leaks play a big amount. If you can only take a very small amount through a very little pipe, and we have a lot of leaks, then that water is not worth as much, right? So think of it this way. And then water quality. Water quality is because although this is a commodity, depending on the quality of your coal, you have different prices. Then depending on your relationship with customers, you have different contracts. So the pricing is not exactly the same. It's not like one tank of oil that costs the same here as there. It's also not exactly like that, but there are big differences in the market between one coal miner and another one in pricing, in realized price per ton, right? What I did is I grabbed the 4 last years from each company, the 10Ks and 10Qs, and what I did is I did research. I want to get these 4 numbers, these 4 inputs to compare the business, how they were doing, right? In coming so, I grabbed all the numbers from the financial documentation of the company. Keep in mind, some companies try to hide the royalties because most of the times the mines are not from them, they are from a government or a family, so they pay royalties on that. And then also the shipping, how it works is miners ship to the port and then the customer pays for freight until their factory. So that cost from the mine to the port, sometimes they take it out. They say, for me it costs this much to take it out of the ground, and we don't count for this cost that the company is paying. So what I did is I grabbed the entire cost of mining per ton, right? So I think that makes a lot of sense, because in financial thinking, there's a lot of the time they say, well, if things weren't like this, I would have such a good operation. But what happens is things are as they are. So costs are a cost, and you are paying these costs every year. So I think it makes no sense to take them out, right? So that's what I did. Since not all of them are 100% met coal, I took the percentage of profits from each year. Some years I took, for example, South 32, they had a year that it was only 7% because they had super high cost that year. I didn't count for 7% of the company for that year, right? So I'd say met coal is 25% of their company at this point, right? From this, as you can see, I took percentage of profits from met coal, then the sales in million tons, revenues, right? So this would be the realized price per ton. So this would be $190 per 1 ton, right? Then the cost, this is the total cost of mining, right? The cost per ton, so this minus this would be the profit, the pure profit, operating profit in a sense. All of this is, I'm not trying to value exactly the companies, I'm trying to rank them and see if one is double as efficient or half as efficient, right? And then this would be the difference, and then I got the average difference between all the years, right? At the end, I got to this other graph. So I took the enterprise value. This would be market cap, the price you pay, plus the debt that it has minus cash. Then the percentage that I think is representative, right, for each year. As you see, South 32, as I said, 25%, not like 18 as it would be. Then the sales, for example, if one company was doing 40 million sales, then 30, then 20 on the third year, and then 15, I wouldn't do the average, right? I would say 15 is the more representative, because if I say they are closing mines, like operations on mining tend to close, and at some point they are not profitable, so they close down. So I try to make the more representative number for now in the future. Then I did the average of the 4 years on cost per ton, and then I did the realized price average for the last 3 years minus 2020. So what I did is 2017, 2018, 2019. I think those were normal market environments. Not that the price is the most important, but last year it was terrible. There was very little volume, the price was super depleted, everything was closed. I don't think it's a good year to pick around. I wanted to see on normal years, not on normal pricing, but on normal years, how good would they compare? Like you see tech, $200 a ton on average for the 3 normal years, right? And then we see met coal, which is Ramaco, it's doing 107. So this is a big difference. I think this is representative. Not that 200 is or that 100 is, but the comparison between them is what I try to extract. Then this would be the difference, right? So the margin from the average, right? I said, this is not for valuation. It's for ranking and then seeing who has the highest quality company. Then if you multiply this margin for the amount of sales, we get the expected operating income. I divided this by the enterprise value to get a valuation, like in a sense, compared for cheapness. I also wanted to see in this very bad year how they were doing. So the last 12 months free cash flow, the companies that have very little percentage of met coal, like if you see here, they still had a very good year. Not compared to previous year, but not a super bad year, right? Then the total reserve, this would be million tons that they have, it's provable and proven, right? Million tons. So this, the tank size, as I would say. How big is the tank? Because I wanted to see if they had many years on the tank, right? If you see Anglo American, for the proven and probable reserves, they only have 13 years left. That's not too good, right? We want to see some years. Of course, they can buy more rights, pay more royalties, move around and do something else. But if we have 40 years to go, that's pretty good, right? We don't have to worry about it. If we multiply the total reserves by the margin per ton, we get expected value in a sense. I wanted to see how much we were paying for the tank, right? In some companies we are paying a lot. Keep in mind, Vale is only 3% met coal, so we could say we're paying nothing for this met coal business in a sense, but I wanted to add it because they have some significant amount, right? From this, I did some rankings. First, I filtered for quality. In quality, what I did is price, average price from the last 3 years, and expected cost, right? Also expected cost, because if I saw that 1 year they had $110 per ton of cost, then 105, then 100, then 95. I think they are improving their business, so I think the mines are being more efficient. So I'd say 95 is more representative in that sense. So I try to pick that number, right? In some cases, if there was a very odd year, I try to minimize it in some way if I could find the reasoning for the huge amount. But in general, average of the two, right? So we can see that the highest quality company would be Teck, BHP next, South 32, Anglo American, and then fifth Warrior Met Coal, right? And then we would keep going. As you can see, once we go down this route, pricing has a big impact, right? If pricing is slightly too low, right, they will be losing money at this point, right? So the higher this is like the more resilient the business will be, right? Then the next thing, I multiplied this by volume, so by sales, so we could get the output, how much expected cash, if you want to say like that, they would be pushing, because although some Teck has higher quality, like they are more efficient, BHP has a bigger operation. So I'd say BHP maybe would request a higher price, right, in a sense. So I ranked them this way by output. Then we have Warrior on fourth, Anglo American on third, Teck on second, and BHP on first, right? And then what I did is, now that we have output, I want to see for cheapness. So I did filter for cheapness. I think this is the more representative if you are a value investor. If you're just scared of picking the best business out there, it could be Teck, but what I want to say is that Teck has 75% or so other business. So you should check on that other side of Teck, right? But here for cheapness, we see that Warrior ranks first, then Arc Resources, Peabody, Teck Resources fourth. So if you see, Teck is much cheaper compared to BHP. So maybe if you want a miner that mines a lot of stuff, BHP also mines a lot of different resources. So you could check what you like more, what you like less, right? Also for the enterprise value, I adjusted for met coal. So if they had 16% met coal, I just took 16% of the enterprise value, right? So this is the way I try to assess for cheapness on the sector. And I think, as I said, this will be the more representative number. If you want exposure to met coal and not pay too much for it, this is a good place to look. Then another factor that I didn't talk before is that this would be inside the business. We have these 4 factors. Then we have a 5th one, which is customer distance. So how far are we from this company, the customer from this company? Because as I said, the miner pays until the port, and from there the customer pays, right, until the factory. That's important because then this has a very big geographical importance, right? If you see here, we can see the miners, right? Each one on the map. So what we can extract from this 5th variable is you can do some macro guesses, right, or predictions. Like if you think this area like here, for example, Australian coal has an advantage to distribute on Asia. So if you think Asia will be consuming more coal in the next years, then maybe they have an advantage. Then we have Bale. Maybe they have an advantage to Africa, South Africa. So if you see there are some developing countries that will need this steel in the future, or India. If you think Europe will still have a strong steel production, then the Polish GSW. If not, Americans, what do they have? They have a good sourcing of Europe, so very good here, and they also have a good sourcing of South America. Sorry, Tech has a good sourcing also this way to Asia, right? So each one has its pros and its cons in this way. If your operation is super bad and your costs are too high and your margins are too low and you have to price higher and so on, that won't make the difference, like in shipping. But it does eventually make a difference. Like if you are 10% less efficient, but the shipping cost from here is over the 10% cost, then they will source from the United States. So that's the main difference. Like realized price is not the only price important, right, in a way. Well, from this, I said, I don't want to make the conclusions, like say which one is the cheaper. You can see which one I'm invested in and why. But this is a good way of doing a sector analysis. You want to see who are the bigger players, what are the key factors, the KPIs, if you want to say it like that. And then from there, you can judge your business. Is it the 5th in quality in the sector and I'm paying like a 10th of the others, right? Is it good value or not? That's the kind of questions you should be doing, right? So I think for the next video, what I will do is show you a bit how I find value stocks, what kind of filtering I do, what website, resources, what places I look for, these kind of companies. If you are interested in that, make sure to subscribe to not miss it. And if you like this kind of content, please leave a like, it helps a lot. Well, everyone take care, be safe, and see you in the next one.